Good afternoon, and thank you all for joining us over your lunch break today. For those who don't know me, my name is Caroline Stevenson, and I am head of the Financial Services Regulatory team here at Burness Paul. So just a bit of housekeeping before we kick off. If you could all remain on mute and keep your videos off during the speaker's presentation, that would be great. If you do have any questions, then please do submit them during the talk so that you don't forget about them, and we will address them at the end if we have got time. And sorry, somebody is saying they are experiencing audio difficulties, but I think everybody else can hear. So hopefully, maybe double check your end. But anyway, so after the event today, we will be sending around a recording as usual, and feel free to circulate this internally at your businesses to anyone who's missed today. So we're all here today to discuss the FCA strategy and business plan, which was published last Thursday. And between the strategy, the business plan, and the regulatory initiatives grid that was published last year, we've now got a clear roadmap for the next 3 to 5 years in terms of what is on the FCA's agenda. So without further ado, I'm going to pass over to our speakers today. I'm delighted to be joined by 3 members of my team. That's Christopher Woodbine, Lorna Stephen, and Sylvia Matheson. So without further ado, over to you, Chris.
Thanks, Caroline, and welcome everybody. So we reviewed this year's business plan and 3-year strategy and thought how best to break down this presentation. And we're going to cover it in the same way as the FCA, essentially mirroring their 3 areas of focus. So that's reducing and preventing serious harm, which Lorna will cover, setting high standards, which Sylvia will talk to, and the promotion of competition and positive change, which I will cover. But before we look at these areas of focus, which will potentially be of more interest to your firm, I think it's important to highlight some of the general items of note that came out of the strategy and business plan in relation to the FCA's operations. So these are that the FCA is expanding in Edinburgh and Leeds. It's created 80 new roles to shut down problem firms that don't meet basic standards. And the FCA wants to transform itself into a data-led regulator. And through the issuance of the strategy, it's trying to achieve a framework by which it can be accountable against outcomes. The FCA also wants to be able to move faster and in a more agile way, particularly in relation to technological development. And also, in addition to the sandbox that it has been in operation for a few years, which fintechs can share ideas with the regulator, it's now looking to launch something called a scale box, which will allow firms to grow faster and meet regulatory obligations at the same time. So moving on, I'm now going to pass it over to Lorna to cover the FCA's focus on reducing and preventing serious harm.
Thanks, Chris. So in reducing and preventing serious harm, the FCA's focus is on protecting consumers from the harms that authorised firms can cause, including tackling fraud and the poor treatment of consumers. Obviously, no one of these issues can be viewed in the abstract, and there is some crossover between the prevention of harm and the proposed consumer duty, which Sylvia will give further details on in the setting and testing higher standards section of our presentation. The FCA identified several key outcomes with reference to reducing and preventing harm, but the ones I will focus on today are reducing harm from firm failure and calls on the Financial Services Compensation Scheme, improving the oversight of appointed representatives, and reducing and preventing financial crime. So in relation to firm failure, the Financial Services Compensation Scheme levy has increased from 277 million in 2011-2012 to an expected 717 million for 2021-22. That's a 250% increase within a decade, and that represents a huge increase in the burden on regulated firms. The FCA recognises that the bill of unpaid redress liabilities from failed firms is pushed onto those that remain in the market, which are often the more stable firms complying with regulatory requirements. The FCA wants to reduce calls on the FSCS by improving firm conduct through measures set out in the Consumer Investment Strategy. This strategy was published back in September 2021, but similarly to the overall strategy document published with the business plan, it is in place for the next 3 years. The FCA highlights a number of key outcomes for the next 3 years in relation to consumer redress, including working with the industry to create the conditions for firms to demonstrate good advice, to reduce professional indemnity insurance premiums, and reviewing the compensation framework to ensure that it remains proportionate and appropriate. The consumer investment strategy also touches on the wider reforms to the appointed representative market, which I will come on to. Advisor firms pay redress from their own financial resources and via professional indemnity insurance. However, capital set aside is often insufficient to pay for redress, with the minimum capital requirement for some advisor firms set at only £20,000. Putting right even a single complaint for poor advice can be expensive, which is reflected in the limit on a single financial ombudsman service award being set at £350,000. This often leaves regulated firms relying on professional indemnity insurance. However, even where insurance is in place, it's not guaranteed that the PI cover will pay out or that it will be available the following year, depending on the stance taken by the market. This can leave regulated firms in default and consumers relying on the FSCS for redress. The FCA highlights in the consumer investment strategy that improving the overall market, particularly in relation to defined benefit transfer advice, will strengthen the availability and appropriate pricing of professional indemnity insurance for firms, particularly in light of mis-selling scandals like British Steel Pension Scheme, which is highlighted in the business plan as an example of the FCA's work to reduce and prevent serious harm. Overall, the FCA intends that its interventions and work in this area will reduce claims on the FSCS and improve outcomes for consumers. Another key area that the FCA has highlighted within the reducing and preventing serious harm aim is the oversight of appointed representatives. This is something that has been a big focus for the FCA for some time now. And for those of you who attended our Horizon Scanning webinar earlier this year will know that this isn't the first time we've highlighted this, and it remains high on the FCA's agenda through the coming year and throughout the 3-year strategy. Some of you will already be aware that there was an ongoing consultation on the new rules for appointed representatives, which closed for responses last month, and we're expecting to see a policy statement and final rules in the first half of this year. Essentially, the new rules would require principals to provide much more detailed information in relation to the appointed representatives being appointed. Whilst previously this was limited to somewhat high-level information, the FCA is proposing that principals report the primary reason for the appointment, details of the non-regulated business of the appointed representative, details of the AR's corporate group, and the nature of the financial arrangement between the principal and the appointed representative, so whether that's commission, flat fees, or additional payments. The FCA has also sought to clarify both the principal's responsibilities and the FCA's expectations of how the principal and the appointed representative should conduct themselves throughout the relationship. Whilst the FCA has said they're not looking to change the content of the rules and they're simply looking to clarify the existing responsibilities and expectations, it's clear from the proposals on the additional information that they are expecting principals to be much more hands-on with their appointed representatives than they have in the past. They've also proposed a self-assessment document, which will be required to be maintained by principals on an annual basis, recording how the appointed representative senior managers meet the fit and proper persons test, the appointed representative's financial position, monitoring processes, the principal's own controls and resources, and a risk assessment of consumer and market harm. All of this is designed to improve the oversight of appointed representatives, both by the principal on a day-to-day level and the FCA in receiving more information about the appointed representatives in the system. The FCA is hoping that stricter oversight will reduce harm cost consumers as a result of appointed representatives not being adequately supervised. As we highlighted in the Horizon Scanning webinar, the practical impact of this could be that some principals simply withdraw from the market, and we're already aware of a number of principals pulling out as a result of the perceived impact the FCA's proposals will have on their businesses. Whilst this may seem a little premature, given that the rules haven't been finalised yet, it does show some concern within the market that the FCA's requirements will distract principals from their core businesses. So now we turn to the final key outcome in this section, reducing and preventing financial crime. The FCA recognises the harm that financial crime can do, whether that's directly to the consumer affected or in relation to the confidence in the wider market. Financial crime can do enormous damage to society. They also recognise that the prevention of financial crime is a collective effort, with the FCA, regulated firms, government and regulatory partners all involved. So what is the FCA going to do over the next year to prevent financial crime taking place? Continuing the work it's already doing in this area, it intends to continue to scrutinise firms applying for authorisation to ensure they meet the standards for financial crime systems and controls that the FCA expects. This will allow the FCA to prevent bad actors entering the system in the first place, gaining perceived legitimacy through registration with the FCA. The FCA also intends to intervene sooner where they consider that harm could be taking place. The money laundering regulations are a key piece of legislation in tackling financial crime and dirty money. The FCA recognises the importance of taking money laundering seriously and confirms in the business plan that its supervisory assessment of firms will include a requirement for a business to demonstrate that it has the policies, controls, and procedures in place to effectively manage money laundering and terrorist financing risks proportionate to the size and nature of the business's activities. This will require firms to have not only considered the potential money laundering risks their business faces, but to also implement policies and procedures which stand up to scrutiny from the FCA. Whilst this isn't a change to the existing requirements on firms, the FCA sets out its intentions in the business plan and makes clear its expectations on regulated firms to have appropriately considered and managed the risks posed by financial crime. This is particularly important for crypto asset firms, who are called out specifically in relation to money laundering risks and were brought under the FCA's supervision for money laundering. The FCA confirms that it intends to take the same approach to the supervision of crypto asset business in line with other FCA supervised businesses under the money laundering regulations, taking a proportional view in line with the size and nature of business activities. The FCA has also stated that it will actively intervene where crypto asset firms are at risk of being used as conduits for illegal activity. As part of the broader aim of reducing the risk of scams in the financial services market as a whole, the FCA is continuing its Scam Smart campaign to help consumers recognise the warning signs of pensions and investment fraud. The campaign provides high-level guidance to consumers on the warning signs or red flags to look out for when considering new investments which may be higher risk or in reality may turn out to be scams. So that's been a brief overview of some of the key outcomes the FCA is looking to deliver in support of the broader aim of reducing and preventing serious harm. Most of what we've discussed here isn't particularly new. A lot of this has been covered in previous business plans and ongoing consultations, but it does confirm that these issues will remain in focus for the coming years. So with that, I'll hand over to Sylvia to discuss the next key focus of the business plan.
Thanks, Lorna. So I'm going to cover the second limb of the three key strategic areas of focus for the next 3 years, that being setting and testing higher standards. So in its 3-year strategy, the FCA proposes a shift in its approach from being driven by processes to an outcomes-based approach, and setting and testing higher standards is fundamental to that approach. So under the strategic focus of setting and testing higher standards, the FCA has made 4 commitments, which are a commitment to putting consumers' needs first with a focus on its proposed new consumer duty and the outcomes consumers get. A commitment to enabling consumers to help themselves through targeted action to make sure promotions are clear, fair and not misleading. Thirdly, a commitment to a strategy for positive change by delivering its ESG strategy. And finally, a commitment to minimising the impact of operational disruptions by testing firms' resilience to inevitable operational disruptions. So although not exactly the same as the priorities highlighted in last year's business plan, these commitments do echo those priorities, with the interests of consumers, unsurprisingly, being a key theme. So under the new outcomes-based approach, the FCA will be measuring the success of its proposals by monitoring key outcomes for consumers. So how does the FCA propose to deliver on these commitments? Turning first to the commitment to putting consumer needs first. To achieve this outcome, whether consumers are being sold products or services which meet their needs, provide fair value, and whether they are receiving good customer support, the FCA will assess whether there is a reduction in the number of upheld complaints made to the FOS about, for example, unsuitable advice or being missold products. However, with this metric, the FCA does recognise that any reductions in complaints may lag behind, and it may take some time to see the impact. The FCA will also measure consumer feedback via its Financial Lives survey,
And for the uninitiated, the Financial Life Survey is the FCA's survey on consumers, how they manage their money, and their experiences of dealing with financial services firms. And the FCA intends to outcome assess whether consumers have confidence in financial services markets and whether they understand the information they are given and make timely and informed decisions by how consumers answer the tailored questions in the Financial Life Survey. So a key element of the FCA achieving its intended outcomes under the strand of setting and testing higher standards is the finalisation and embedding of the new consumer duty. And part of that will be ensuring that firms understand what is expected of them under the new duty. So by the end of July this year, we can expect to see the feedback statement on the proposed consumer duty alongside any finalised rules and guidance. Now, I just wanted to touch briefly on the proposed new consumer duty, as it's set to have a significant effect on the financial services sector with the introduction of a new consumer principle that requires firms to act to deliver good outcomes for retail customers. The duty is intended to set clearer and higher expectations for the standard of care firms give their customers. So the proposals under the duty would require firms to act in good faith, avoid foreseeable harm, and support and empower customers to make good financial decisions. So with that, there's an expectation on firms that they will provide products and services that not only meet the needs of their customers, but offer fair value. There will also be an expectation that consumers are equipped with the information to make effective, timely, and informed decisions about products and services. And it's expected that consumers should receive good customer service. So that's a broad brush overview of the new consumer duty. We did discuss it a little bit at our horizon scanning session, and we may have some more on that to come. So turning to another commitment under the strategic focus of setting and testing higher standards, the FCA is committed to enabling consumers to help themselves. The aim under this commitment is to reduce the potential for consumer financial losses arising from mis-selling as a result of non-compliant or illegal financial promotions. And the FCA intends to measure its own progress by being able to demonstrate an increase in interventions on non-compliant promotions over the next 3 years, and also an increase in the number of warnings on its website relating to unauthorised entities. And the Treasury has indicated that it will propose legislation for a gateway for authorised firms wanting to approve financial promotions for unauthorised persons. So dependent on the timing of that legislation, either during 2022, 2023, or further on down the track, the FCA expects to include information about firms' permissions to approve promotions on its register. So unsurprisingly, ESG priorities features under setting and testing higher standards. And under this commitment, the outcomes the FCA is looking to achieve are trust in consumer protection from misleading marketing and disclosures around ESG related products, and high quality climate and wider sustainability related disclosures to support accurate market pricing, which will assist consumers and investors to choose sustainable investments and drive fair value. And the FCA intends to measure its progress for its ESG commitments by delivering metrics to measure the incidence of misleading marketing where ESG products are concerned, and metrics to measure the increase in the quality and quantity of climate-related and sustainability disclosures. So evidently some work to be done on the ESG side of things, which will span over the upcoming 3-year period. And the FCA intends to achieve its ESG outcomes by embedding ESG issues and how it authorises firms. It will also be working closely with the government to support the government ambition of greening finance. You will likely have come across the government policy paper roadmap on greening finance. A priority item for the FCA in the coming year will be leading the ongoing development of a labelling regime for investment products and an effective ESG ecosystem to support integrity in the market for ESG labelled securities. During 2022, we're expecting to see the FCA's report covering the recommended disclosures of the Task Force on Climate-Related Financial Disclosures. So turning now to the final commitment under this strategic focus, it is a commitment to minimising the impact of operational disruptions. The FCA's proposed outcome is to see firms demonstrating resilience to operational disruption. Progress will be measured by the development of a new metric based on the volume, scale, severity, and time to remediate operational disruptions. As part of achieving this outcome, the FCA's authorisation process will include a consideration of how firms that are subject to the operational resilience policy have met the expectations of the policy, which includes firms setting appropriate impact tolerances for their business. And between March 2022 and March 2025, the FCA will be assessing how able firms are to remaining within their impact tolerances ahead of the 31st of March 2025 deadline. So I'm now going to pass you over to my colleague Chris to cover the third strategic focus of the business plan.
Okay, thanks, Sylvia. Apologies if you hear some noise in the background. I think before we look at the FCA focus on competition and positive change, it's fair to say, at least in my experience, that while financial services firms have a general awareness of competition law and are familiar with the concepts of abusing a dominant position and cartels, there's perhaps room for firms to do more to consider the issues of competition, particularly in the context of the digitalization of products, big tech and data. Indeed, firms will need to do more to ensure compliance in this space, as competition is a key tenet of the FCA strategy, or enforcing competition, I should say, is a key tenet of the FCA strategy over the next 3 years. So if we move to the first slide, the FCA want to use competition as a force for better consumer and market outcomes. They want to use competition, it should be a force for good. Firms should compete for customers on the basis of service, quality, price, and innovation, and competition should encourage better outcomes for consumers. So the FCA are looking to adapt their standards to reflect current and emerging risks while enabling innovation and competition in the consumer's interest. So the FCA makes 3 commitments in the strategy to promote competition and positive change. The first of these relates to preparing financial services for the future. And we talked to this somewhat in our horizon scanning webinar back in January, where the government is looking at legislative framework that the FCA operates within and seeing what this will look like in the future. So while this is yet to be finalised, one of the key proposals is to include a new statutory secondary objective for the FCA around growth and competitiveness. Secondly, the FCA are committed to strengthening the UK's position in global wholesale markets. On this, the FCA have a programme of change for further reform in primary, secondary and post-trade markets, which include reforming rules around when a prospectus is required and its contents, transparency in equity markets, and the creation of a new sandbox for new market models of infrastructure. And the third limb, probably the most interesting, is the FCA's commitment to shaping digital markets to achieve good outcomes. The FCA have said that they will continue to actively participate in the Digital Regulation Cooperation Forum, and they do this alongside the Competition and Markets Authority, Ofcom, and the Information Commissioner's Office. The FCA have also said they'll work with the government and stakeholders on a new pro-competitive regime for digital markets, and this is known as the Strategic Market Status Regime. So it's clear that the impact of digitalisation on financial services is high on the general competition agenda as well as the FCA's. Digitalisation has brought disruption to traditional financial service business models, and with it potential challenges around competition. Financial service firms should take note of what is happening with big tech in the competition space and its role in shaping the regulators' views. As many of you will know, there are significant investigations underway looking into tech companies' practice and commercial arrangements, and the Competition and Markets Authority has undertaken various research around the use of algorithms, AI, big data, and what that means for competition. To give one financial services example, the CMA review into algorithms found banks' use of algorithms in the mortgage approvals process to be potentially problematic. So moving to the next slide. This slide's really just to quickly cover the examples that the FCA included in this year's business plan around what it's doing to promote competition and positive change. So the two examples, the first one relates to asset management. The FCA is keen to highlight the work it's doing to ensure asset managers provide value to consumers, and they're also highlighting its increased supervisory focus that products with ESG properties are presented to consumers in a way that is fair, clear, and not misleading. Also on asset management, it mentions its collaboration with global regulators on topics such as fund liquidity to ensure common standards. The FCA also highlight crypto assets. The FCA is working closely here with the government and other parties through a crypto asset task force designed to design a UK approach to regulation that balances innovation and competition alongside the need for orderly markets and consumer protection. A key takeaway is that stable coins will be brought under the FCA's regulatory perimeter. Firms should also note the FCA statement last month reminding firms of their existing obligations where they are interacting with or exposed to crypto asset services. Firms need to ensure that they make consumers aware when they are interacting with unregulated services. So in terms of the business plan, the FCA, in relation to appointed representatives, the consumer duty and ESG, the FCA very much see a role for competition and positive change in supporting its outcomes in these areas. So in relation to ARs, the FCA will consider the potential impact on competition and innovation, for example, in relation to regulatory hosting. The idea here is that the rules applied to ARs must be constructed in such a way that they do not diminish competition. Currently, the AR regime is a useful tool for firms to use as a springboard where they're small and allows them to grow to a position where they can bear the cost of full authorization. On the consumer duty, the FCA will publish final outcome-based rules on the proposed consumer duty. Sylvia touched on this. In essence, the idea here is that firms can find new ways of serving their customers with clarity about the FCA's regulatory expectations, which will foster competition. And then in relation to ESG, the FCA will work with international regulators, the fintech community to solve global problems through innovation. It will continue to work with other stakeholders to enable innovation through its dedicated facilities, such as its Sandbox, its Tech Sprint, and its recent Green FinTech Challenge. So before I wrap up, and I don't intend to go into much detail here, but given the FCA's considerable strategic focus on competition, I thought it was worth just having one high-level slide that those that are attending the presentation today can take away around competition law. So competition law forbids cartels and other potentially anti-competitive agreements. It prohibits abuse of a dominant position. And this is all contained within key UK legislation, so namely the Competition Act 1999, FISMA 2000, and the Enterprise Act 2002. I think it's also important to note that the regulators in this space, so the Competition and Markets Authority, the Payment Systems Regulator, and the Financial Conduct Authority have concurrent powers to investigate competition breaches. A key takeaway for firms is, and this is often not known, is that there's a duty to self-report. So regulated firms that do come across competition issues must bring them to the FCA under Principle 11 of the FCA's handbook. And also there's the concept of leniency that firms should be aware of. So those that have participated, for example, in cartel activity can choose to give detailed confessions of their infringement in return for significant reductions or complete immunity from penalties from that infringement. So that brings me neatly to my final slide, where a recent case was brought by the FCA in 2019. Actually, its first decision under its competition enforcement powers, where it brought a case against 3 competing asset management firms who shared strategic information during one initial public offering and one placing shortly before the prices were set. In that case, 2 of the firms were fined, but one of the asset management firms was given immunity under the competition leniency program. And then separately, just to bring it home and highlight how seriously the regulators are beginning to look at competition, there was a case in January this year where the UK payment systems regulator fined 5 prepaid participants in the prepaid card market, a total of £33 million, MasterCard sharing the main burden of the fine, after concluding that the 5 parties infringed competition law by agreeing not to compete or poach each other's customers. And then finally, the main areas of competition law enforcement focus for the FCA are currently expected to be in the data market, after investment companies raised concerns about high barriers to entry in the benchmark provider space, and in relation to digital platforms, which I've touched on heavily in this presentation, and that will be initiated through the FCA's participation in the Digital Regulatory Cooperation Forum, which also includes the CMA, Ofcom, and the Information Commissioner's Office. So that concludes the presentation, but we'll move on to some Q&A.
Thank you, and thanks to all our speakers today. If anybody does have a question, please either pop their camera on and ask it, or pop the question into the chat if you like. But I hope you all find that as interesting as me. I know that each of you, if you're in-house, in a firm, that some of these issues, if not all of them, will come across your desk in one whether it's a project or if it's just a question or something that you need to implement. So we hope that this has eased the burden slightly of making you read the business plan and strategy by yourself, and gives you a bit of a snapshot into what we can expect over the coming years from the FCA. I don't think we've got any questions coming through, so that's a good sign. It means that everybody can head off and get their lunch. But before we wrap up, I just wanted to say that if you did enjoy that presentation today, you've not got long to wait, because our spring series of our FS Academy is kicking off next week, so next Wednesday, for the next 4 weeks. And over the course of the next 4 weeks, the team will be covering items such as AML, buy now, pay later, APP fraud, and the Queen's Care Duty, ESG, and I think I said buy now, pay later. So there's quite a few interesting topics are coming over the next 4 weeks. And as always, the FS Academy is sort of based at entry level, so for more junior members of staff or people who are just interested in those topics and looking to get just a basic understanding. So they'll be kicking off. Feel free to sign up to those. And if you've got any questions meantime, or want to find out any further information on any of the topics that's been discussed today, then please do get in touch. But thank you all for attending, and thanks to Chris, Sylvia, and Lorna for speaking, and also for James, our trainee, for helping with the slides, and of course our BD and events team for pulling this together at such short notice, given them only a week to get it organised. So thank you so much. Enjoy the rest of your day, and enjoy your Easter weekend when it comes. Thank you.